What's up, YouTube? It's Joe Catchpolia sitting on the couch making some money investing in fractional real estate online as usual. Today, I just want to do a little bit of an update on the topic of the loan from the Mount Vernon DAO to this Quitman property. There was quite a bit of discussion after that last video. Earl and Gibson and a couple other people involved posted a whole bunch of due diligence related to being able to do that loan. So I want to just give you a little bit more info, but also encourage you to jump into the Mount Vernon Discord and take a look at all of those due diligence documents. But then, in addition to that, I just want to talk a little bit more about um, why I think lending inside of the DAOs doesn't make a ton of sense, especially once we start talking about doing it in these fund type things like the ULD or EARLDAO. I'm gonna talk a little bit more about what those are and everything in a few minutes. First, I just want to cover a few things on the Quitman loan from Mount Vernon. Again, I don't have any skin in the game on that one. I sold my Mount Vernon tokens. When I did that earlier video, I was just wanted to point out all the types of things that I'd want to see in order to make a loan, of that type. And, very quickly they were able to share virtually all of the data that I had asked for. I think that, if you, they're not going to do a title policy for this loan, but they're about to refinance the underlying loan, and so I think we could look at that title work if this was something that you were interested in looking at. So there is a first mortgage for 437,000. That's to a hard money lender. They're in the process of refinancing that. It'll take a week or two. They'd expect that this loan would, or at least the mortgage for this loan would be recorded after that refinance goes through. If it were me and I were doing this lending, I would want, I normally want the title company to submit that for recording the day of closing. And so I wouldn't want the funds to transfer until that happened. Again, not my decision. That's the, the prudent sort of stance that I would take. Um, they did give us an appraisal. I wanted to point out, so it's really unclear the way the appraisal is written. Oh, did I? So they've checked the box subject to completion per plans and specifications on the basis of hypothetical condition that the improvements have been completed. So this is the type of appraisal that they're doing because that box is checked. But then they also wrote in the comments that section A has been completed, and B is under construction, making it seem more like it's an as-is appraisal telling you the current condition. But that's not, when they check this box, that means it's been, they're assuming that it's done according to the plans and specifications. So a little bit weird that they did that, and then they also included the current info, because I mean, this is often, you'd use this if you have this, if you check this box subject to the following required inspection based on extraordinary assumptions of, of this, not being required or whatever. So I don't know why they did that combination, but this leads me to believe this is the after repair value. The 730,000 is subject to completion. One of the things that I wanted to point out, they've already have more money than that into this. It looks like from their capital stack, they currently have $795,000. That doesn't really impact the loan, right? It impacts the equity investors that are already in that deal. Although Earl shared something that said, that's after repair value between 730 and 850. I had just put a question in the Discord just a little while before. I waited a little bit before doing this video, but I didn't want to wait too long. He's probably just not in there at the moment. But finding out where that 850 number comes from would be important to me. But even at the 730 after repair value, if you take $70,000 plus their existing debt, you're still below $70,000 or 70% of the after repair value. So it is, relatively low loan to value for this. Even though you're a second loan, and that's one of the things I want to talk a little bit about. Is comparing the risk of this to like if I'm just getting a first mortgage and ground floor. And yes, being behind a first position loan isn't is typically going, being in second position is typically higher risk. But I wanted to mention a couple of things that I think mitigates that in this situation. Again, I'm not doing a full underwriting of this loan or this deal, but I want to give you some things to think about. And just to be fair, because I threw out all those things that you should be concerned about, I wanted to just mention some of these. So okay, they shared all the pictures of where they are in the construction process. Uh, it's a really interesting looking property, and they kept some of the features, which I'm really happy with. Sometimes people, just totally demo these and make them completely modern, and I think it ruins it. So I liked what they did with this. Um, but so basically, if you go through these, and if you read the appraisal as well, Unit A, which is the main house, is done. It has, and it has it has tenants in it. They are on a month-to-month lease, according to the what they posted in the Discord, for $3,500 a month. The principal, interest, taxes, and insurance on the first mortgage is going to be somewhere around $3,400 a month. And all of this is just based on the info that they provided. Obviously, you want to dig into that and do your own due diligence on how accurate each one of those pieces are. But so basically, as is with with the tenant in place, they're covering the debt service, principal taxes or principal, interest, taxes, and insurance from that. Um, Obviously that doesn't do anything to pay for the second loan that we're doing, but you have this second unit that is, all the money basically that is generated from the second unit, you can imagine can go towards that second loan. And your other things that come up, vacancy, repairs and maintenance, those sorts of things. But with a freshly renovated property, don't expect a ton of repairs and maintenance. Um, but so, and then most, I would expect that most of that 730 value is already there in the main house, even though it says it's subject to completion. And obviously, until you get the ADU completed, you don't have the full value there. But I think this is a lot different from having a vacant single family home that you're renovating to flip, which is the standard um, ground floor model, which I was comparing it to, right? So I think it is definitely a different risk profile for the property as a whole, and so you have to decide for yourself: does that fully mitigate the fact that it's a second mortgage or not? Does the fact that they have so much skin in the game? I mean, they have 300,000 plus in cash into this. Now, to some you might say, well, part of that might be sunk cost because if the ARV is really 730, um, that it doesn't matter that they have that full. It's really just the difference between all the loans and the value. I think a lot of people just don't see it that way when they're actually investing, right? Especially when they're this early in the process, and they might just believe that the 730 is a very low end of what the actual value is for this. Um, so, and this is the condition of the ADU portion. So obviously, there's a little bit to go for that. But a lot of, it appears that a lot of the major things have been done. They did provide the plans and specifications, so I thought that was, or I mean, these are the plans, and this is the permit, the stamped set. Is that right? Um, and like I said, you should jump into the Discord and really read through everything that they provided. Gibson shared his credit info. They have the full loan agreement. I did pull that up. So you should read this, and this is assuming that the 70,000 is what was voted on. I think there were three options in the vote that went out. Um, One of the things I think that they don't have, um, default interest is one thing that people were talking about. Default. Security instrument repayment of this note. Let's see. Is that true? Oh, default interest. Yeah, it's the same rate, right? And so that's not great. So one of the things, yes, there would be an extension fee due if they went into default, but if they didn't pay it, they're still just paying the 13% interest. Normally, I would want a higher rate of interest on default, and then okay, if they extend and then they still haven't paid it off, I typically put a 50% higher rate in my notes uh, after a default than because otherwise, yes, you can move to foreclose on it, but if not, there's not a real strong push to pay that back because of the higher rate. So would like to see that. But that's just my personal preference on that specific business point. That is not legal advice. You can do what you want in that section. But yeah, if I were going to be voting for this, definitely you want to read through that, figure out what's going on. But so the other topic, and I mentioned this in the last video too, is I think that we just have a whole bunch of this where we're talking about doing more loans between the DAOs, and I think that I want to just talk a little more about why I think it's problematic. So there's a proposal. It's not out yet for vote, but people are talking about. Um, there's in this property package. So we have three properties here. One is being sold. They want to take that money, and the discussion right now is one, to make a portfolio loan to the ULD, which is not explained, hasn't been explained to me at all. I did ask that question in the Discord, didn't get a response yet, but there was a whole bunch of other stuff being talked about, so I'll probably follow up on that. But then also to buy some shares in the ULD, and I don't remember what else. But so there's a discussion there, and then there's also um, the EARLDAO, which is where the DAOs have been already lending some money back and forth, primarily up till this point in order to account for all the Yom stuff. So if one DAO owed money to Yom and the other DAO was owed money, it's a way to sort of account for all of that. And so we've seen that EARLDAO be used for that, but now it went live. You can actually invest in this, put new cash in that will then be lent out to other DAOs. Um, all both of those, right? The loans from the DAO to the ULD. Investing in this, and I want to make sure this is clear. What I'm talking about is not if I went and clicked buy on this and invested in this directly. I think it's much less problematic than if I ask my DAO to invest in it. And the same thing with the ULD, right? If you want to invest in the ULD directly, that's one thing. Doing it through a DAO, I think, is completely different. And so I want to jump into a couple of the reasons why. And this, the same thing applies to making a loan. Even if it's just a single loan from one DAO to the next. One of my favorite things about investing in fractional real estate is the ability to value the DAO, right? Like you should be able to say what my token is worth, and that when you compare it to buying a stock or you compare it to buying a REIT, right? In most of the DAOs, I just have to figure out what is that property worth, and then I add that property value to whatever my current cash on hand is if I have a reserve, right? And that's it. That's how we value the DAO. And so it makes it very easy to make an investment decision currently. Well, once you start owning tokens in other DAOs as well, right? If I own tokens in the ULD, if I own tokens in EARLDAO, or if I'm making loans, then I have to value the property, value my cash, and then figure out what these other entities are worth, right? Are they worth whatever the tokens are currently trading at? Are they, if it's a loan, does that loan need to be valued at a discount or not? And, one of the things, I don't think that's too difficult, although I think the ULD is much, much tougher at the moment because you just have a bunch of bad loans in there, or loans that may take a very long time to be paid back. EARLDAO is another story. Earl contends that you're always going to be able to redeem tokens for $50. I think that's a little naive. I think that it's, he's not the Fed, right? He doesn't get to issue new value whenever he wants to. And so, I think there's going to be times if a large number of the loans in the EARLDAO are not performing, and a large number of people want to redeem tokens, there's just not going to be cash available to do that if more people don't want to buy tokens on the other side. So I think for nominal amounts, it could be true that yes, they'll always buy your tokens back. But in the event that something catastrophic goes wrong across multiple DAOs, I just don't see how they can actually hold that, just guarantee that $50 value is held up. If you in fact you could just guarantee that, well then yeah, I think it would be a much different story. But it's not. It's not a cash equivalent. There is risk. There's risk that those DAOs, um, that are being lent to, somehow that value goes to zero and they can't make any repayment back. Um, the other issue that I have with the EARLDAO currently is, and I've mentioned this to him, is there's no spread, right? He's saying that your estimated APR is 12%, but then also the loans that are being lent out from EARLDAO are 12%, and so um, unless you have 100% of the funds lent out 100% of the time, you're not going to have that. You're not going to be able to pay out 12% interest rate, right? And I think you can come pretty close to that, and maybe you'll have a rate that you're getting pretty close to until you start to think about, okay, well, how much cash are we keeping available for people to redeem their shares? Because I mean, if I'm thinking about I'm a DAO and I have a large chunk of money in EARLDAO, and I'm doing that because I want to use it, sort of as a supplement to my reserve. And so, okay, then I have a huge repair and I need thousands of dollars all at once. Is that going to be available, as a limit order where I can just say, okay, I need 5K right now? And if it is, then if that money is just sitting there, well, then where's the 12%? Like, how is it earning that money to be able to pay it out otherwise? So, I think there's a little bit of, uh, a little bit of a problem with that model and believing that it's going to stay at a $50 value. If you look at any lender in the world, they typically have a spread, and oftentimes it's multiple percent, right? Like the banking thing, it used to be it was the 363, like we borrow at 3, we lend at 6, and we're off to the golf course at 3, something like that, or out of the office at 3. You can actually look that up. That was like a meme in banking before memes were a thing, right? Like we used to talk about that in lending quite a bit. The more that spread gets compressed, the more problems you have. And even like you can say, okay, well, yeah, but that's partially to cover profit and overhead, which is true. But even like a lot of the nonprofit lenders that are out there, because these exist, especially um, for like community development and whatnot, they always still have a spread on their cost of capital. And so that's one thing. It's kind of a tangent. It's one of the reasons why I don't fully believe that $50 value is always going to be there, right? And so that's why when I'm valuing my DAO, uh, I'm gonna have to figure out, okay, do I just give it face value? Do I give it what it's trading at? Like for like especially like if you're looking at the ULD right now, if we held ULD shares, what am I valuing the DAO at with those shares, right? I mean, there's been shares or there's been tokens for those up for sale for $32 and change for a while that nobody's bought. The most recent tokens in that I purchased were at $20. I think $20 is a pretty fair price for the ULD, right? I think 30. This is a good time to say it. Please like and subscribe. In the description to this video, I have links to all the places where I currently invest in fractional real estate. Please do your own due diligence on all of those platforms and any properties that I mentioned. Just because I think a certain price or a certain property makes sense doesn't mean it does. You want to do your own due diligence. Also, if you want to discuss any of this stuff, there's a link to the Discord in the description of this video. Feel free to jump in there. We're talking about all different platforms. Um, and I just want to mention again, I know I've said it a couple times, but some of the links that they say they're going to give you money, there are a lot of terms and conditions in that, and then some of them just aren't doing it at the moment, even though they say they are. And so you want to dig into that yourself before you count on getting any of that free money in those links. Okay, but so yeah, so that's my main issue, right? Like we start to the more different assets we start to put into the DAOs, the more difficulty we have in valuing it. And then also another great thing about the DAOs is we have control, right? We have control of our investment. We picked the property, and we get to vote on what we do with that property. As soon as we start buying shares and other things or making loans to other entities, we're giving up control of what's happening to that money, right? Okay, we made the loan, but now it's being used by another group. And so, two of the things that I like a lot about fractional real estate investing, we're giving up by lending within the DAO. Which is cured very simply by whenever we have a liquidity event, like in the Ohio, 3 property package, we just send that money out to individuals who then can control what they're doing with their funds, right? Some of them are going to reinvest. Some might put it in EARLDAO. Some might put it in the ULD. Um, if you don't think that they would do that, then that's a pretty strong admission that you don't think those are great investments, right? So it's a matter of, um, where they, and then just letting those people reinvest it where they want to. And then if they think that the ULD is a good value, or they think EARLDAO is a good value, then you'll see their money going there. But then they'll have that control, that direct control of where their capital is versus, it's moving from inside the thing that they picked to something else completely that you no longer have any control over. And no voting, right? Well, maybe the DAO, that's an interesting question, right? If the DAO earns tokens in that, who's voting those tokens and when that comes up? I mean, I guess that we would be. We haven't, I don't think we've experienced that yet, so that'll be interesting to see. And then I think, one of the things I did a video a couple weeks ago on how all the problems with decentralization, right? Like we're decentralizing, a lot of the decision making, and I think that leads to, poor outcomes. But now we're centralizing risk in a lot of ways by tying DAOs together, right? If I'm taking some of my profit, that I could just be reinvesting, and I'm putting that into another DAO, now my DAO's performance depends on how that other DAO actually performs, right? If it's not able to make that repayment, or maybe it is sometime way down the road, um, it can greatly impact the returns that this DAO is making. So we're centralizing the risk. So basically we have decentralized decision making and centralized risk, which is the worst of both worlds as far as I'm concerned. Um, we're getting none of the benefits of the REIT. We're having like a professional team that makes decisions as a whole, for the portfolio. But you're getting, you're starting to add in some of the downfall, which is you're spreading your risk, and you're also muting your returns a little bit, right? Uh, if you have any sort of good portfolio on Lofty, I'm hoping that you're making more than the 12 or 13% that you're getting in these two DAOs. Maybe not as good of a risk adjusted return, and that's a decision you have to make, right? Like, does the debt aspect of it make it a better risk adjusted return for you? But it's certainly, muting the overall returns. And that leads into the next point of, uh, you know, if you are thinking about your own portfolio, you typically, like I like to have a certain allocation for debt, a certain allocation for equity. Oh, I got some trackers there on my device. If you have, uh, you lose control of that by the DAOs starting to make some lending within your entity, right? So now this is no longer, I have my debt investments, I have my equity investments, and now I start to have some hybrid investments, right? And in ones like this Ohio 3 property package, it turns into a pretty big, if we're just doing it to supplement the OR and we're adding another 5K to the EARLDAO on top of our regular OR, and we really believe we're going to be able to redeem it for $50 whenever we feel like it. I don't really, that's a much different story. If we're putting a significant amount of capital to work in the ULD, which is, at the moment one of the biggest failures on the platform, there are plans to fix it, but right now those are just plans, and so um, I think it's a little bit reckless, I think. And we're just changing the allocation of that DAO, greatly, right? So no, now it's no longer an equity investment, but it's also not a pure debt investment. And so the way we look at that is going to be, I don't know. You'll have to think about how does that fit into your portfolio. The next person who decides to buy that, are they only going to look at the value of the two properties? If they're buying those tokens from you, are they looking at the overall value? That's if they're not somebody who's interested in investing in debt, are they going to buy something that has a large, portion of that? And that's why there's not a huge there's not it's really tough for me to see the benefit of doing it inside the DAO versus letting individuals do it, other than you're forcing people to do it that wouldn't do it on their own. Like, I mean, I think that's the only real reason. If you think, okay, well, we're keeping some liquidity inside the DAO, uh, then let's do cash, right? I mean, cash is the only, these are maybe these are going to be liquid, but you're paying a fee for that liquidity, right? You're paying your, um, are we? I'm assuming you're paying your regular lofty fees. Uh, oh, are you not paying lofty fees on these? Oh, I don't have enough cash in there right now. Um, Yeah, I don't have enough cash. So I'll have to. Oh, and I can't pay it with a. Well, I don't know. So maybe you're not paying fees on this. That would be weird. Um, but that would be cool if that's what's going on. And so then, okay, that makes it a little bit more like liquidity, right? If we're not paying fees on the buy and sell. I don't know. Maybe they're going to try to do that with the ULD too, and then all of a sudden it makes it a little bit more liquid. Although again, you've seen shares of that just sit there for a long time. But then, one of the things that I think is really being lost on in this whole discussion is running a debt fund isn't easy, right? And I think I talked about this last time. I've worked a decent amount in lending. I worked in mortgage servicing quite a bit. Um, this isn't something that. So the first thing is the people that are good at making equity investments are almost never the same people that are good at lending. When you're lending, the biggest thing that you're looking at, there's never any upside, right? You're just getting a certain amount of money and that's it. And so you have to have 100% focus on your downside. Um, I think it is where a lot of my negativity in the way I look at deals comes from is from the lending experience. If you think about uh, what it takes to do well with property investments, you need to be optimistic. You need to be a problem solver. You're basically looking for ways to make deals happen. And so the mindset, I think, is completely opposite. The people that do well in lending are always looking for a reason to say no to a loan, right? And then if they are going to say no, then it's up to the borrower to say, this is how I can sweeten that deal a little bit, right? Maybe I'm giving you more collateral. Maybe I'm giving you an additional promise to pay. Maybe I'm giving you a higher interest rate, right? And so that's one of the problems I have with the EARLDAO is if they're all at 12%, um, I can't ever have risk adjusted pricing, right? But I think in general, I think we'd really want to think about who's making the decisions on if we're going to lend to one another or not. We already discussed the ULD made terrible decisions. They just basically approved every single loan, and they all looked the same. And there was no risk adjusted pricing. There was no, discussion of do we need something extra to make this deal happen. It was just okay. Here's a loan, and you can do it. We don't have any track record for either of these entities, right? We don't have, and because well, one, I mean, we have a record for the ULD, and it's terrible. We don't have one at all for the EARLDAO, and so asking our DAOs to make a big investment in something with no track record or statistics to look at, um, it's very different from making a real estate investment, where we can very easily look at the value of that property. Uh, I also think I really worry about the scale, right? If you look at debt funds, and I actually, at one point in my career, um, looked at starting a debt fund with a group of people, and we were trying to do very small loans, similar to what's going on here, and everything that we could, all the math that we did, and everybody that we talked to that had experience in this space said, if you're not doing a $10 million fund, it's really you don't have the right economies of scale, and really there were some people that got all the way down to maybe you could do a $1 or $2 million fund, but beyond that, if you get much smaller than that, which is what we have here, right, $100,000, a couple $100,000, um, you're going to run into problems where any individual loan can have a real impact on your overall, so if you end up in a situation where you have a real default, a property value goes to zero, there's nothing recoverable, um, it becomes a real problem. And so, like, let's say, okay, bare minimum, you want to have 100 loans, right? If you have a fund and it's less than 100 loans, you don't have the right diversification to make sure that your interest rate's actually covering um, some total losses. And if let's say our average loan on here was 15K, I mean, I don't know, maybe that's a little high, but that's 1.5 million, right? I mean, that's again, that'd be bare minimum, very small fund to start. And so, we don't have any scale here. And I think that that's problematic in that you really need scale to have a diversified risk, right? Like when you're looking at debt as a risk adjusted, looking at the risk adjusted return of it, you're typically looking at large portfolios of debt. Like if you watch the way that I've invested in ground floor, I got pretty frustrated when I got down to 50 loans, right? Like I was looking to have 150, 200 loans, And that's just because of my lending experience, understanding that that wide diversification is really necessary to do well. Otherwise, one or two bad loans can just tank your returns, across the whole board. Um, yeah, I already mentioned not having risk adjusted pricing. Um, the other thing that I think that we really run into a lot, or could run into a lot, is having, conflicts of interest. And we already see this with some of the decisions being made with DAOs, like when they're, uh, so okay, let's say I own this property, and somebody else has a large stake in the ULD right now. Well, taking money from this to help rehabilitate the ULD and help kickstart it and make it going, it's probably benefiting holders of the ULD much more than it is benefiting holders of this Ohio 3 property package, right? And I own, I don't know, 60 or 70 tokens in the ULD, so maybe that's helping me as well. But it is, whenever you have these loans from one DAO to the next, you have a situation where you might have people that are benefiting much more on the other side, but they're affecting the vote on your side, right? And I mean, you can imagine that happening in a lot of different ways. And I'm going to talk about that a little bit more when we talk about my creating abuse bullet point. But then also too, is somebody doing this for free, right? Like who's actually going to take the time to evaluate the loans? If we're doing it as a community, I think we've just proven that we don't make good decisions when we do it just in a very broad group. There was some discussion of like somebody mentioned having a Senate. I think it's because we're talking about, in terms of like a republic versus a democracy, right? Where we're limiting the decision making. Um, if you've got people that are doing that, are they just doing it for free for all these loans? Because at a certain point, you already see a lot of the property managers who were theoretically getting paid. I mean, some of them aren't getting paid on some of the properties at the moment. And we see a lot of complaints about like, hey, I'm doing all this work, I'm not getting paid for it. And even sometimes some of the people that are just like proposing votes and stuff, they're like, oh, I'm doing all this stuff for the DAOs and there's all these free riders. Well, you're creating a situation where either you've got to pay people in the DAO to do this, for to to look at every single loan, to underwrite it, to do the due diligence and make a decision, or we've got to do that collectively. And I just don't know that we're going to make good decisions on loans if we do it that way, especially again because there's going to be some conflicts of interest, right? Anytime that there's a loan being made to one of the entities, there's probably the people that are going to be most involved in talking, in that discussion are going to be ones that are going to benefit from the loan being made to that entity. Um, and again, this all becomes a problem because of it's in happening, a loan inside one DAO to the people inside of another DAO versus like if I'm just making this decision on my own to take my money and invest in the ULD or take my money and invest in EARLDAO, all of a sudden that's gone, right? I can just invest with my own interests in mind and making decisions that I think are best for the investment in that entity. Um, the other thing I'm really concerned about, okay, if we just have somebody, a smaller group of people that are making this decision, um, if we're paying them anything to do that, if they're getting some equity, if there's any remuneration, I always forget that word, but if they're getting paid anything for that service, are they a licensed investment advisor? Because if not, I think that this is at least some gray area, but I actually think that we're stepping into some trouble. I know when you have like investment clubs, if some of the members of the club actually get paid to give advice or to teach the others, that they need to be investment advisors. In this scenario, you know, I don't know. And then if they're not getting paid again, like why is someone spending a ton of time looking at every single loan in there? Are they doing it just because they're going to have a big investment in the ULD? Uh, if so, why wouldn't I just make those loans on my own? And this is something I've thought a little bit about. Is sometimes when and some people have done this already, right? As individuals, made loans to different DAOs. In that scenario, I think it's a completely different thing. I think it's perfectly fine. Um, because you're just assessing your own risk and your own return, and you don't have any you're not like dampening your value or control of some other asset by doing it, right? It's just being done directly. But I think this is something that we really need to look at if there's going to be some select group of people that are reviewing and making decisions. And if there's anything in it for them, if they're getting some piece of equity, if they're getting, paid a fee for it, if there's, if there's anything going on there. And then again, if they're not, why are these people spending a whole bunch of time, doing that? If they're just doing it for free and they're trying to be nice, well, that's fantastic. Is that someone whose time is worth anything, right? Like if you're just willing to give up your time for stuff, and sometimes the answer is yes, right? I mean, like there's a lot of times where people are, um, but then, how long are they going to be willing to do that for? Is that something that's going to be interesting to them for the next 6 months, the next 6 years? How long? And then the other thing, and I started talking about this with the conflicts of interest, but it just, having these situations where one DAO is lending to the another, you have these situations where you can have a lot of abuse, right? Like, so this was the example I was starting to say, like, okay, so I'm the borrowing DAO, right? There's some of us that have large investment in that DAO, and we're, and we could get into the other DAO and negotiate terms, and so that our interest in one is larger than the other, right? And so we can get into that other one, negotiate terms, and vote, control that vote and vote for a deal that's being lent to us that is uh, giving the borrower DAO much more benefit than the lending DAO, right? And I think that I don't think you'd really see it in the opposite direction, although I guess you could. You could have a situation where you controlled the borrower DAO and just really give them a predatory loan. But I think that would be, I think it's less likely because I think when we see this happen, it's going to not be so overt or so intentional at first, right? It will be, um, we just need that loan and we jump into the other one and there's people that already are involved in the lender DAO and they just really control that. And one of the things is it doesn't mean you have to own 60% of the shares to do that, right? I mean, if you look at the votes, you just have to be the active and loud minority to sway a vote in a DAO, and so or the ones that are actually voting, because there's a lot of people that just don't actually vote each time or don't really get involved and just go along with what people are saying in general. They're like, oh well, that's a more experienced person, I'm just going to listen to them, uh, and may not realize like, oh well, there's this huge advantage that they're getting in this other DAO for us to do this here. Um, but so that's really all I wanted to bring up is I think that the Universal Lending DAO, I was an investor in it initially. I still do buy it whenever I can get tokens for $20. I think it's something that Lofty needs, right? The platform needs some way to borrow money, for DAOs to borrow money. It's very difficult to borrow from traditional lenders without having, you're seeing all these hoops people are trying to jump through in order to borrow from traditional lenders. Well, there's a reason for that, right? Historically, lending to entities has been a very risky endeavor. And now DAOs are entities that don't even have somebody, um, it's really in control. If none of these loans are going to have personal guarantees, and so just to share, I think I shared this once before. I made the mistake of one of my personal loans where I sold a property to an entity with owner financing. Um, One of the earliest ones I did, I didn't get a personal guarantee on that loan. I didn't realize the default in the paperwork was if I just had it, in the contract where I sold it, if I didn't, specifically include that I was going to get a personal guarantee, I just assumed I was. I was new to Texas, didn't realize that that wasn't the norm here, right? That if you lend to an entity, you don't automatically get a personal guarantee. So we had to so I have, I still own that mortgage. When I've gone to, ask people to buy it in the past, they want to give me a huge discount on it because there's no personal guarantee. Well, every single one of these loans is not going to have a personal guarantee, right? It's just to the entity. Um, it is why we're getting higher percent interest, right? Because these are more akin to hard money loans. But even if you go to hard money lenders today, they're still typically at least checking your credit score. They're often looking to see what your liquidity is outside of the entity. Um, we have none of that here, right? And so there's a reason that institutional lenders and other lenders don't want to lend to us as DAOs. And so even though we really need this way to lend to each other or to get additional funds into the DAOs that are struggling, um, I think that right now we're starting to give up some rationality uh, because, for expedience, right? Like the easiest way for us to get money into the ULD or the easiest way for us to get money into the EARLDAO is to have a vote for one of these entities that has a bunch of cash on hand to do it. Um, but is that a rational decision for the investors in those DAOs that have the cash at the moment? And that's where I think things really fall apart because, all of these reasons lead me to think that investing in these entities is something that individuals should do, but for the other DAOs to do it, um, I think you're just destroying too much value by doing it, right? And you're taking away too much optionality for the individual investors, right? If you're just assuming every single investor in that DAO, the best they're going to do with that money is hit 12%. I think that's a terrible assumption to make. There's plenty of people that claim to make much higher returns than that. And if they are, like, why would you ever want to just give that up for a 12 or 13 or 14% return? Where the other side, if you distribute the funds to the individuals in situations where you have liquidity events, the ones that 12% is the best they're going to do, they can go ahead and put their money there, and then everybody else can put it in what they think the best investment in the platform is. And I think if we're being honest, if you think that this is a good investment to go into the EARLDAO or the ULD, then you would just assume if you distribute those funds that that's where most of that money is going to end up anyway, and so there's no downside to distributing it. Um, I think that most of us realize that's not the case. I mean, I think some allocation to those inside of our personal investments makes sense because you're maybe for some risk mitigation, and it's why I like to have a certain amount into debt versus not just all equity. Um, but what each individual's risk profile is like, I think, traditionally, if you're younger, you want to have a lot less debt and a lot more equity. As you get older, you want to have a lot more debt and a lot less equity. And it's because it's a way of balancing risk and return over time. Um, you're taking that ability to make that allocation away from people to a certain extent by doing it inside the DAOs, whenever they have extra capital versus dispersing that and letting it go, where it's going to do each individual investor, the best. All of this discussion, I want to make sure it's clear. I'm not saying I don't think we should have reserves, right? Like this is all for money that is in excess of what a prudent reserve would be. You want to make sure, obviously, that you have enough cash to support those properties long term. Beyond that is what I'm talking about with, and that's where most of this discussion is happening as well. So, anyway, I think that's everything I wanted to talk about with this. Um, sure, there's going to be a lot more discussion in the days to come because both of these things I think are hot topics at the moment. And like I said, I know the ecosystem needs a solution. I just want to make sure that we're not forcing a poor solution, on into the situation where because we need it now, right? And I mean, if you talk to a lot of the people on the platform, there's a lot of people that are managers, that are investors, that are, for whatever reason, they have more money tied up into deals than they expected. There's a lot of cash-strapped people out there, cash-strapped DAOs, and that often just leads to very suboptimal decision making. And it's why I just want to start have this conversation about all of this. Like, if this particular DAO ends up buying the ULD, is that going to kill me? No, I mean I only own 50 tokens in this. Like it doesn't really matter at all. But I think overall, I think it's a poor precedent. I think it's not a great idea to do. And I think it's not the best. I don't think it's creating the most value for any of the investors in the DAOs that are doing it. Now I think I'm really done. Until next time, just going to keep making mistakes so that you don't have to.